Anyways, I've known Asa for a few years, and Asa is a financial advisor, and I thought it'd be interesting to hear kind of a adjacent business, but similar, right? It's all intertwined. Hear their thoughts on what's going on in the world. There's a lot going on. We see gas prices rising. We see the stock market not looking good. Crypto looking even worse. Real estate hasn't really dipped yet, but it's starting to plateau. And I thought it'd be interesting to hear kind of from an adjacent business how how he sees things are going, and I kind of want this to be more of like a roundtable discussion, and we can kind of just talk and ask questions, and yeah. So take it away, Asa.
Cool. Well, first off, thanks for having me in today. It's always fun when I get to Zoom with Isaac. He also didn't mention that there's quite a height disparity between the two of us. So just watching the two of us run in general is quite comical, because I'm like 5'6" and he's like 7'5" or somewhere around there. It's all, angles up at that point. 7'4". Oh, my bad. I'm sorry. Short. When you've got those many inches, sir, you can spare one. All right. Yeah. So like you said, I am a investment advisor with Primerica Advisors. I was on the West Side for quite a while. And then my parents are moving, so I jumped back across the state to help them with that process. But yeah, so what's going on in the world of finance? Because yeah, I'm interested to hear what you guys have to say in kind of the world of real estate, because you look at different metrics and you get some different data sets than I do. So I'm excited to hear that as well. But from my perspective and what's going on in finance in general, really we're seeing three overarching market drivers that are kind of creating the ups and downs and the turmoil that you're seeing in the industry right now. And I do apologize, I don't have any graphs or anything to share. I get stuff sent, but there's a big disclaimer at the bottom that says not for public distribution. So, unfortunately can't be sharing those up on the screen, or else get quite a bit of trouble. But yeah, so the three major drivers that we're looking at right now, everybody's pretty familiar with them because they're what's in the headlines. So the first one is the war in Ukraine, right? And not for the reasons that most people think. The humanitarian side is awful and what's going on. But economically speaking, Russia and Ukraine don't really have a lot of impact on what's going on in the US. The real concern, and it's kind of interesting because before I was in finance, my background, I was a captain in the Army. The real concern with that conflict is that it expands to incorporate other countries, and it blows up into a much larger, more drawn out conflict than what it currently is. And that could have larger repercussions. Russia and Ukraine, they're not major trade partners. The only thing that Russia really can control that affects us is going to be oil. And we do have access to our own oil reserves, but they supply a lot of Europe, right? And so by cutting off supply to Europe, they drive up prices that way. So that's really kind of the concern with that market driver. The other two are really closely tied together. One of them is just COVID. We're still dealing with it. I mean, in the US, it's not really much of a thing. We've kind of canceled it earlier this year. We all said it's not happening anymore. We don't believe in it. And, thoughts aside, other countries in the US or other countries in the world are not taking that approach. China currently is still pursuing their zero COVID case policy. And they've got 250 million people still in lockdown. And what China is that's a major producer of items that we import, right? So if they've got a large portion of their workforce down, then we're just straining that supply chain that we've depleted over the last 2 years, and we're not refilling it from our trade partners in Asia. Taiwan's another big one with the computer chips. So when we opened up our economy, because we canceled COVID, our demand increased, right? Well, if they're not increasing their production to match our increased demand, and that just drives prices even higher. And that's where a lot of the inflation concerns came from for earlier this year, like 6-7 months ago, is when that really started to take off. And so what that does is that then prompts the Fed to step in, because their stated mandate is, of course, fighting inflation and keeping inflation to about 2% year over year. And so they are currently exercising their power to slow the economy, because our increased demand from opening our economy is what's also kind of adding to this. So they want to slow that growth down over time. And the concern really isn't so much that the Fed's doing this, it's that this is much more of an art than a science, right? our world is so interconnected and there's so many different facets at play that, there isn't an exact rule book on how to slow the economy correctly. And what people are concerned about is that the Fed is going to slow it too drastically, right? And then they'll push us into a recessionary era. And people use the word recession, and there's a lot of fear associated with it because what everybody thinks of in recession is they think of 2008, right? They think of the Great Recession, the Great Financial Crisis of '08. But the actual technical definition of a recession is just 2 consecutive quarters of negative GDP growth, right? That just means the economy either stayed the same or went a little bit down for basically 6 months. There wasn't a lot of growth. So the actual definition of what qualifies as a recession is a lot more mild than what most people think, because they're associating it with this 10 million people unemployed, 40% collapse of the financial sector and the housing market all paired together. But that's not actually what constitutes a full-scale recession. So that's one concern. The other concern is that the Fed does a great job, right? They hit all the nails right on the head, and they slow the economy down to like maybe 0.25%, 0.5% growth year over year, right? So then we have what's called a low growth trend economy. And then the concern with that is, how long did it take to reach that? And how long do we need to sustain that to bring inflation back under control? And one of the driving factors of that is the consumer, right? And this is one of the reasons why, even if they push us towards that recession, kind of trend, I don't think it'll be nearly as bad, because there's a fundamental difference between the consumer standpoint and the consumer balance sheet from that '08 era to where we're currently at today. If you look at credit defaults, if you look at average bank savings, if you look at consumer spending, they're still up. The consumer spending's gone down a little bit because people are a little uncertain about it, but people still have money. You still see people out buying coffee and going on trips and doing all those types of things. So the consumer is still in a really strong standpoint. And so even in a low growth trend economy, we could probably sustain that for a while. The question just is how long, right? And nobody knows that. And nobody knows that because the Fed doesn't know that. They're still trying to figure out what the proper steps are and what the proper course is to make sure that they slow it just enough. So those are kind of the 3 major driving factors that I'm seeing in the world of finance. That, and there's a 4th minor factor, and Isaac, you and I briefly chatted about this yesterday, I think, is that for a lot of professionals, right, people who've graduated high school or college in the last 11 years, this is the first time the economy's ever really done this. I don't really count March of 2020 because it was such a quick down and then right back up that people really didn't have time to absorb it. The headlines were terrible for a little while, but we bounced back so quickly, and then ended the year much higher than we started. I mean, there was 27% rate of return on average growth in 2020 in the S&P 500, right? So you're looking at it absorbing that low and then basically just continuing from there. So over the last 11 years, we've basically just done this in the market. This is the first time where we've had a prolonged period of more kind of up and down, right? You're starting to see that volatility a little bit more, and people just get nervous about that because they've never had to deal with it before. And so they watch their, account values drop, right? And they panic because they think they're losing everything, and then they sell. You don't actually lose anything until you sell, right? That's an actual loss. Other than that, it's just a change in value, change in valuation. And so that's where you're starting to see, these major sell-offs that people are doing over the last like 4 weeks or so, or people are just unsure of it. They're getting scared, and then they sell off. Now, maybe it is, maybe it isn't. A lot of times people in the last couple of years have started to invest in kind of cool companies, very disruptive companies, things that brand new business models and new technology and stuff. And those types of companies tend to struggle in these types of markets, right? Because a lot of times they're not profitable yet. They don't have strong cash flow, and they're not a tried and true method, right? And so people get nervous about doing that. And that's where you start to see some of these downward valuations from earnings reports from like the first quarter of this year. Yeah. Any questions so far? I just threw a lot of info at you guys.
Well, maybe you were going to get to this. So if I'm jumping ahead, feel free to say I'll get to that. But we're obviously dramatically affected by rising interest rates.
Mm-hmm.
Have you Does that have any effect on you, on your business? On the stock market, I should say.
On the stock market. Yeah, it does, less so because the interest rate's rising and more so because people don't like change and uncertainty. What I'm seeing right now is a lot of people reacting to the uncertainty of what is the Fed going to do? What does Russia do? And again, uncertainty of how are people reacting to this? So people don't like that type of environment. Again, they're used to pretty much stable growth over the last 10 years. And so that's where we're starting to see the dips. So yes, it is, but at the same time, I also look at it as a huge opportunity for a lot of people, depending on kind of your phase of life. My younger investors, I'm telling them, hey, this is the time to do it. This is the time to jump in if you've got extra change laying around, because, you know, again, fundamental differences from some of the other time periods that had this type of turmoil. And it's a chance, honestly, to get some great companies. Their stock prices are down, you know, 10, 15%. So you're basically buying 10, 15% discount from what you would have done even earlier this year. So a lot of my clients who are younger and have kind of that timeline before they're looking to utilize these funds, or they've got some time before they need to use them, this is a great chance for them to get in. And some people are capitalizing on that and some people aren't. Kind of depends. Yeah.
I think one way we've seen the stock market affect us, and some of this is speculation, but I had multiple clients in the past 2 years say, yeah, I probably wouldn't be able to afford a home, but I can actually put 150,000 down because Ethereum is up 400%, and I bought it at $750, and now it's worth $4,000. And so, you know, I made $100,000 on that in 6 months time. And so just by nature of the fact that, you know, people's net worth has gone down dramatically. People who had significant money invested in the stock market and cryptocurrency and so on. And so, so because of that, people generally hunker down, and they don't have the capital that they had, even though the capital wasn't liquid, it was liquidable. And now it is still liquidable, but it's worth significantly less. So they just don't want to touch it. So we're seeing that because now people don't have the down payments that they had. And so, and you factor that with the fact that interest rates have gone up by two or more points since December. And it's really had a dramatic effect on people's buying power.
Yep. No, absolutely. Yeah, I would agree with that. I would say that it's funny that you mentioned crypto, because crypto is such an interesting space right now, with everything that's going on. There are a lot of people who made a lot of money in cryptocurrency. That's a fact, but it is still such a brand new platform, software, even product that, and a lot of people got very excited about it and sank a ton of money into it. And, you know, when it was going up to 60 grand a coin and you bought it, you know, at 5,000 a coin, that's a great return. That's phenomenal, right? But it's so volatile, and it is so, what's the word I'm looking for? It is so at risk for major shifts. I mean, it was yesterday, Bitcoin was at like 29,000, right? So it's lost 50% of its value, and it's kind of stayed there since about November timeframe of 2021. It's gone up and down a little bit, but it's pretty much hovered in the 30s, high 20s to mid 30s, I think. And again, a lot of people sank a ton of money to that. And so now they're concerned that if they pull out, they'll realize this loss, because some people bought when it was much higher and was more expensive, right? And you also just have to, you kind of have to look at it and say, well, what's the regulation control on it? You know, what's the guarantee that this is, you know, a viable investment product long term? And there isn't really any, because it's not regulated. So there's a lot of freedom, which is why a lot of people really like cryptocurrency, right? There's a lot of freedom with it, but it's still in its infancy as a currency. It truly is. And there are some major events that could really affect the value of the current coins. I mean, there's hundreds of coins out there right now, and there probably will be, you know, hundreds more over the next 10 years as this technology develops a little bit more and it's implemented more. And I mean, is there spot for it in a portfolio? Absolutely. I think there probably is, but I don't know that I think people are putting too much into it currently, and they don't have the funds to lose that. I mean, currently I'm kind of telling my clients, I can't really speak to what you should or shouldn't do with crypto because the licensure that I have doesn't cover it because it's not a regulated thing. But you need to be okay with losing the majority of those funds. If you are comfortable doing that, then yeah, put the money in there. Why not? But if that's money that has a purpose, if that's rent money, if that's house payment money, if that's vacation money or car money, that's probably not the spot to be putting it in there. You could have good upside potential, you really could, but you also have massive downside potential, which is like losing everything. Yeah.
I feel personally attacked right now.
I wasn't gonna point you out specifically, but no. But I mean, it's not necessarily a bad thing, right? Because again, it's a new technology and everything, but it definitely is not something that I would sink, 40 or 50% of my portfolio into. And that's what a lot of people have done. And a lot of people are hurting right now for that exact reason. They don't have the liquidity that they really need to maintain their current lifestyle, or to accomplish those goals that they'd set out to, 7 months ago, even a year ago. Any other questions?
Or comments? Yeah, if anybody
Or
has
comments
anything to add, what are you guys seeing as far as, well, on this topic?
Yeah. Any diehard crypto people in here?
Depends on the month.
That's fair. Yeah. But the other thing is
last year. Oh man, I was diehard last year.
This is the way of the future. Well, and so that's interesting that you bring that up, because that's one of the things that I deal with a lot is we as humans are linear thinkers, right? And so we always kind of assume that, and it's not even a conscious decision, but whatever the current trend is that's going on is that we'll continue to do that, going forward. And so with people last year, they were like, well, crypto, it's growing exponentially. It has been growing exponentially for the last 10 years. It's going to continue to do that, for the foreseeable future. And so that's what caught a lot of people off guard, is that we don't live in a linear world. We live in a very much up and down world. And so a lot of what I do with my clients is, well, hey, just because it's happening now doesn't mean it's always going to be like this. Same thing with the drops in the market. For you guys, it's a little bit different because that's, real estate does tend to stagnate a little bit more, but people generally speaking still have money that they're trying to grow. So I'm a little bit less affected by it than you guys would be. But even just because the market's dropping now doesn't mean it's always going to drop. It will probably bounce back, within the next year or so. I don't know when exactly it's going to happen because nobody knows. But if you look at historical trends, it's going to probably jump back. So yeah, interesting. Linear thinking, psychology. Any other comments? Are you guys seeing the plateau, starting to see a plateau in real estate over on the West Side?
Yeah, I definitely think so. I mean, at least we're not seeing 20 offers per home and homes going for 20% more. At least we're starting to see, far less, less waived inspections, less paint above the appraisal, more low appraisals, less cash buyers, and so on.
Definitely seeing a slowdown. I had a new listing come up last week in Spanaway, crickets, and I know it's priced right and it's all good, but we didn't get anything over the weekend. And I went in and like the 15 houses and several mile radius around it, I went in and looked at showing time. No one was getting showings. It was like a few here and there, where last month you tried to go in and make showings same day. It was good luck, but it was just nothing. So definitely seeing a slowdown, I think.
Less competing offers too, for
Oh,
sure.
yeah.
That's a big thing.
I was listening to, there's a new Bigger Pockets podcast called On the Market, and one of the co-hosts runs a successful brokerage up in Seattle, and he was saying over the last 2 weeks, they have over 50 active listings, and showings are down 85% across their whole brokerage up in Seattle area, which was interesting to hear because I'm a co-lister on a listing up in Everett, and we've had 5 total showings in two weeks. So we had felt that as well.
Sean, did you say a 30% reduction?
85% reduction in showings.
I don't know how I misheard that. Sorry.
I just saw a report showing, I mean, it's across the US, but inventory is raised over 8% in just a week. So inventory is going up, showings going down. That plateau, it's happening.
Is the Seattle market, it's a pretty desirable area. So for plateaus like nationwide, is it fairly resilient to that where there still is interest, or is it kind of behave across the trend line?
Well, so everybody in this Zoom meeting, all of us were not licensed back in the last dip. So we're all going based off of what we heard. What I heard is as far as the average across the country for the last economic crisis, we dipped by probably 10% less, give or take. Would you agree with that, Kim? Roughly 10% less than as far as I mean, I know you weren't licensed then, but our housing market dipped. I think the average across the nation was like 38%. Does that sound about right? I think it was. I thought that number's in my head, but I could be wrong on that. And I think we were around high 20s. So you disagree? You're muted.
I don't know the stats on that.
Oh, okay. Like someone's gonna totally call me out for being completely off on that, but
I do think you're right. It was in the 30s nationwide in terms of the decrease.
Yeah, I mean, in general, I mean, dollar dips, we were higher than most because our average housing price is higher than a Midwest home. So, a home in Detroit that was worth 80,000 might be worth 50,000. So it only lost 30,000 in value. But that's a percentage is much higher than here, where if the average home was 300 at the time, we went to more of a 220,000 average price. So I think that's generally consistent, that the percentage, the dollar value that we drop, generally the coasts, right? The West and East Coast, they drop more dollars, right? But their percentage is less. So I would expect that, especially for areas like Tacoma, where we have really a great organic job market. We have just a ton of huge job providers here, such as JBLM. Here in Tacoma, we have the harbor, the port of Tacoma. We have Boeing, Amazon, Microsoft. So there's so much around here that it would be, I would say we are more insulated than a place, not to pick on Detroit, but a place like Detroit, which was really reliant on car manufacturing. So when all these car manufacturers declared bankruptcy in the last crash, that was the job market there. So I definitely think we're better insulated, but a economic crisis affects everybody, obviously.
So it's interesting that you mentioned the job providers organic. I was just at a leadership summit, and in Spokane County, there's currently 2 jobs for every single person that's unemployed, which is quite the shift over the last 10 years. And a lot of employers are not sure how to handle that, because now you're having to fight for employees as opposed to employees having to fight for you. So it's an interesting shift in dynamic as well. Just kind of another changing times, unprecedented times, or at least not for a long time.
So I guess we've talked about what's happening, the status quo, and this is like major asterisks. We're all speculating, but speculation is fun. What are you foreseeing? Like I can start. Like I'm foreseeing in the next 6 to 9 months, we'll definitely start to see prices in real estate go down. I'm not going to say a percentage because I don't think I have an opinion on that. But they have to go down. I did a meeting on this a few weeks ago showing in December a 3.5% interest rate on a $750,000 home versus today a 5.5% interest rate on a $750,000 home. Same down payment, same taxes and insurance and PMI and so on. The payment went up by $925 a month. Same exact price home, just the interest rate. That was the only thing that changed. So, you know, $925 a month is not something that people can just be like, oh, I'll pay that extra per month. Sometimes it is, but it's something that you will just have to, buyers will have to look at homes that are priced lower, or the market will have to catch up to the new payments that are, you know, directly affected by interest rates. So because of that, I don't see even a possibility of prices staying the same. I mean, even factoring in ridiculously high inflation and the cost of everything going up, I think prices will have to go down at least slightly. What do you see in like the near future? And then again, total asterisk, this is predictions. None of us know. None of us have a crystal ball, and no one's going to come back to you and say, you said this. But do you think we are still on the downward spiral and there's a lot further to fall? Or do you think we're hitting the bottom as far as the stock market and so on?
Yeah, yeah, definitely big asterisks. And, you know, like I was kind of saying, we're not totally sure because there are so many unknowns. You know, economics was my favorite subject in school because everything's so interconnected and everything works together, which is cool, but it also is so tough to analyze. So, you know, nobody knows what the Fed's going to do because the Fed hasn't known that either. They're still making, you know, calls each meeting, and you see the market reacting to comments made by different board members. Nobody knows what China's going to do. That's going to be a big driver of inflation and those inflated prices and the supply chain. You know, nobody knows what's happening with the war in Russia, what Putin is ultimately going to do, if he feels that they can, you know, pull back, or if it does expand into something else. So I think that there's still a lot of volatility in the future that's probably going to be, that you're probably going to see at least for the rest of this year, maybe into next year as well. I think you're going to start to see inflation get actually pulled back under control. All the predictions I've seen, I work with 12 asset managers, and I get the benefit of kind of weighing all of their different quarterly updates. And everything I see is that they expect inflation to be more back under control by to the stated goal of 22%, no, of 2% by about 2024, 2025. They expect it to be back in there with more of that long-term trend. So I think, and then, yeah, I think you're going to see still a lot more volatility, right? I think that portfolios that have companies with really strong cash flows are going to be great. Companies that are not exciting, things like Procter and Gamble, it's not a oh boy type of company, but it's something that everybody knows. It's got products that everybody needs. You know, if you don't buy that toothpaste, we're all going to find out real quick, right? And so I think that's probably a great bet for a lot of people for the next foreseeable future. Yeah.
What's your, I mean, we all are in sales, and we have to deal with fielding these questions and fielding the fear and the sky's falling. What's your optimism? Like why is the sky not falling? You know, why are you still optimistic? Why are you not, you know, just taking everything out and buying gold and ammo?
That'd be a very North Idaho thing to do. That's somebody from Coeur d'Alene, I'll tell you what. No, yeah. So, I mean, I am actually incredibly optimistic. I think that this is a really phenomenal time. And for me, myself personally, and for people who have time, you know, before they're looking to use these funds. Again, I said, this is a great time to get in and purchase at a discount. If you put money into the market now and we just break even, over the next year, you're looking at a gain of about 18%, right? So even just then making it back to zero would be a gain by putting money in at this time. So I really do think that this is going to be a really phenomenal time. And then for me, myself personally, as an advisor and working with my clients, this is where I earn my keep, right? People don't know what's going on. They're concerned. And so I get to reach out to them. I get to talk to them. I get to explain what's going on. And then, you know, I mentioned this to Isaac one time. I get to use my favorite line ever, which is, you know, if you know anyone who also has kind of concerns or isn't sure what's going on, you know, feel free to give me my contact information. I'd love to explain, you know, to them kind of just the same way I did to you. And so this is a huge referral time for me, because when people are scared to have hard conversations, right? And investment guys, similar to real estate people, they haven't really been in a market that's like this in a really long time. They haven't had to have these hard conversations of, hey, my portfolio is down 20% year to date. Why is it down 20%? I thought that was impossible. And so a lot of people stick their head in the sand. And for me, you know, with my background in the military, I don't mind the hard conversation, because I know the plan that we put in place and I know what's going on in the world and I can explain it. And I get to kind of be a resource to people for even if they don't work with me, I can still explain what's going on so they feel better and they don't ultimately make a decision that's going to affect them. But I think over the next 10, 15 years, I mean, I have a ton of optimism about what's going to go on, because all of the problems that we're seeing right now are very fixable. It's just a time thing. How long does it take to fix them? I mean, one of the biggest drivers, again, the supply chain. We can refill the supply chain. It's just a matter of when, not if, right? So I am excited, and I do have a lot of optimism. And I think this is a great time to start getting into investing. I mean, it's like real estate, right? If you're a real estate investor, when do you buy? You don't buy when it's like the bubble. I mean, you do because you can buy all the time, but like you really start to purchase when there's a bit of a plateau or a dip, because that's when you can optimize on that and get your best return. Same principle.
Absolutely. Well, and like for us, I mean, this is kind of not relating to you as much, Asa, but I think the key, if I have a client who really wants to buy a home, right? They are just sick and tired of paying rent. Their credit's good. They're ready to buy a home. I'm not talking about investors right now. I'm talking about just regular home buyer. To me, the way I'm educating them right now is, first, let's hear about your goals. I think it's always great to start that way when someone talks about buying a home. When Asa first started talking to me about my Roth IRA and so on, he started with the goals, and I really appreciated that. I took that from him, and I was like, oh, I gotta lead with that when I'm talking to my clients, because if you just start talking to everybody like they're the same person, then you're gonna lose people. You want to hear, what are your goals? If I have somebody moving here and being transferred to JBLM, and they have a really good likelihood of having to transfer in 2 years, I honestly think I'd talk them out of buying a home. I really do. And I haven't said that before, by the way. This is the first time in my career I've felt that way. I think I'd be doing them. I mean, I'm not going to like tell them, no, I'm not going to help you. If they're insisting on it and they can hold it and keep it as a rental if the market dips, great. But like, if you're asking my advice, I probably wouldn't. But if you are somebody who has a secure job and you can afford the mortgage payment, the only problem with the market dipping is you lose the out of being able to sell the property and breaking even. You have to hold, right? So again, it kind of comes down to goals. What are your goals? And if someone says, well, we're moving our family here, I've got someone I'm working with who's moving from Louisiana. He's moving his family here. He just signed a 10-year contract with working in the hospital, essentially. And he was asking my opinion. And I said, I do think the market is poised to dip. But when he's looking at the rental market, because he was comparing the two, there's nothing in the rental market and nothing that fits his family, nothing in the school district he wants to be. And ultimately I said, you can refinance out of these not so attractive rates. If you don't need to sell, it doesn't matter if you buy a home for $700 today that's worth $600 at the end of next year. It doesn't really matter. That's just spreadsheet money, right? I have a home that's worth $500 I owe $380 on, and yeah, it's kind of cool being like, oh yeah, I've got $120,000 in equity. It doesn't mean anything. I can't touch it right now because I can't refinance, right? So educating people on that process, that if you can afford the payment and you feel really secure in your job, it's still it still is not a bad idea to buy a home, because you are still paying down the loan. And you still have the tax write-offs. That's huge. You can write off the interest that you pay on your home and so on. And then on the flip side, if you're talking to an investor, if somebody has money to invest, if they find a property that covers the margin between the payment and, you know, vacancy rate and capital expenditures and so on, and the rents cover that, could you maybe buy a better deal in a year? I think so, but I don't know for sure. Will they be loaning at these interest rates in a year to investors? Maybe they'll be significantly higher. I've seen some projections that expect us to go 7% for home buyers and 8+ for investors. So if you're an investor and you can get a rate at 6.5% and the tenant pays your mortgage and some, is it really a bad idea to buy a home? I don't know. You know, but anyways, I think that's just something to take away from that is find out what their goals are, find out what your client's goals are, and maybe just be a little more, don't bank on appreciation anymore, right? I think that would be key. Don't bank on that. In the past, it's been like, well, you move in a year, it's probably worth 15% more. So that's great. And we've all seen that, right? It's not going to be that way anymore, but there's still times that it makes sense to buy a home, even in this market. Well, anything else anybody wants to add? Any other questions or anything like that? This is, you know, any thoughts? I guess not. We can wrap this up. But thank you, Asa, for taking the time. This was good. I'd be interested in doing some more of these type of meetings, just kind of as the market changes, which it seems to change every day. Just kind of hearing the outsider's perspective. I find this type of conversation really interesting, and because even though we're not directly connected, it's directly connected for our buyers, right? They have money in crypto and stocks in their retirement and so on, and they're seeing those dip, and that affects their buying power. And so even though it doesn't necessarily affect us directly, indirectly it does. So I think these type of meetings would be good to continually have.
Yeah, thanks for having me in. I really I enjoyed it. I always enjoy getting up and public speaking and stuff. It's always a good time. So it's super nice to meet everybody out today. And thank you, Isaac, for having me. I appreciate it.
Yeah, absolutely. And then yeah, if anybody wants to connect with Asa directly, I'll include his contact information. Like I said, I've been working with Asa for quite some time, and he's really been a pleasure to work with, and has helped me set up. Well, I already had my Roth IRA set up, but helped me present me with some good options. So anyways, yeah, let me know. I will include that in the recap email. And yeah, thanks everyone for joining.
Awesome. Thanks, guys.
Absolutely.
Thanks, Asa.
All right, guys, have a great day.